All right. Who runs the Ohio Division of Real Estate and Professional Licensing? A, Commission Chair, B, Governor, C, Secretary of State, or D, Superintendent? Okay, so we have D so far. All right. That's correct. D, Superintendent. Good job. Okay. Is there a limit on the total of fines the Ohio Real Estate Commission may impose on a licensee? And if so, how much? Is that A, yes, 25,000, B, no, there is no limit, C, yes, 5,000, or D, yes, 10,000?
Yeah.
And then so far we have B, B and A, and then okay, we got two A's. All right, three A. So it is gonna be B. No, there is no limit. That was a tricky one. So the Real Estate Commission can impose a fine up to $2,500 per violation, but there is no limit to the total amount of fines that the commission can levy. Oh, that was tricky. Okay.
What's that?
Okay. Next question. The Ohio Real Estate Commission must include one member who represents the A, Ohio Bar Association, B, interests of the public, C, Ohio Bankers Association, or D, Ohio Association of Realtors. All right, good job. That is correct. It's going to be B, interests of the public. The Ohio Real Estate Commission consists of A, four brokers and one layperson, B, five brokers with at least 10 years experience, C, no more than four members of one political party, or D, one broker and four lay people. All right, we got A. Good job. Correct. It's going to be four brokers and one lay person. So there's going to be a total of five. Okay, next question. Who has the authority to impose fines on Ohio licensees in addition to the superintendent of the Division of Real Estate and Professional Licensing? Is that A, Secretary of State, B, Director of Commerce, C, Real Estate Commission, or D, Attorney General? C? Who's C gonna be? All right, so the correct answer is C, Real Estate Commission. So the Real Estate Commission has the authority to impose fines up to $2,500 per violation, in addition to fines imposed by the superintendent. All right, that one went by quick. And we can always do another one of those later. Okay, so next one we will do is property management.
Yeah, I can see why that'd be helpful.
Oh, for them,
Yeah.
yeah. Right. Gosh, I need to sit up straight. All right, property management. The broker's property management account must A, bear 6% interest, B, bear no interest, C, be accessible by the property manager slash broker, or D, be part of the broker's trust account. Oh, this one's kind of hard. And again, if you're new to the chat, feel free to put your best guess into the chat. Don't worry ever about getting it wrong because we're all learning. Yeah. All right, we got C's and B's. A, B, and C. All right. All right, Brenda says B. Oh, it is C. Be accessible by the property manager slash broker. So a broker who manages property needs to have a property management account. This account is used for the owner's operating expenses. The broker is the one who deposits and withdraws funds from this account. This account is separate from the broker's trust account. Oh, that's a tricky one. Definitely memorizing that for this exam. And then you'll be good to go. A lease begins on September 13th and ends on December 31st of the same year. What type of leasehold estate has been created? A, a periodic tenancy, B, a tenancy at sufferance, C, a state of years, or D, tenancy at will. All right, we got B. Okay, good job. That is correct. It's going to be estate 4 years. Definitely knowing the difference between each one of the various leases is going to be very helpful for the exam. And in the question rationale, it gives a really good description of each one. Okay. A landlord occasionally uses their master key to enter rental houses that they own while residents are away. They avoid giving notice because they are looking for undisclosed pets, any damage or physical problems, and the like. This would be A, not allowed under the tenant's freehold estate right. B, allowed because of the duty to supervise tenants' use of the property. C, not allowed under the Fair Housing Act. Or D, not allowed under the implied covenant of quiet enjoyment. So we have C and A. All right, majority A. So it is going to be D, not allowed under the implied covenant of quiet enjoyment. Yeah, this one was tricky. But a landlord may enter the lease premise only with advance notice or the tenant's permission. Entry without notice or permission is a breach of the implied covenant of quiet enjoyment. The landlord's promise that the tenant's exclusive possession of the property will not be disturbed. All right. A property manager decides to offer some additional services beyond what is specified in the property management agreement. They may do so after A, giving the tenants 30 days notice, B, the management agreement is amended in a writing signed by the owner and designated broker, C, providing notice on the Department of Licensing, or D, obtaining written authorization from the owner. I was thinking it might be B, or I was thinking B. And B is correct. It's going to be the management agreement is amended in writing, signed by the owner and designated broker. A good way to remember this is anything that is in writing and signed by both parties is most likely going to be the best answer. Okay. If a tenant pays a lesser on a regular basis and occupies the property for successive intervals of time, the tenant would most likely have which of the following leasehold estates? A, pure act tenancy, B, tenancy at sufferance, C, tenancy at will, or D, estate for years. All right, we got it. Good job. Everyone answered very quickly. Correct. That is going to be A, periodic tenancy. I like including the question rationale to every question because there's super helpful content in it and a great way to just kind of either put it into a study guide for yourself or make flashcards. All right. So we covered so far state governance of the real estate profession and property management. What topic would you guys like to cover next? All right. We're going to do financing. Gosh, this was one of my hardest sections when I took the exam.
That's why I picked it.
Yeah, really?
It's a little bit-
It is difficult, yeah. So which type of single mortgage loan exists when two or more different parcels of property are offered as security for the loan? Is that A, fixed rate, B, wraparound, C, variable rate, or D, blanket? Are you shredding things? Yeah, it's so funny. All right, we got D, blanket. All right, good job.
Yeah,
This was always my favorite one, and I didn't get this question on my exam. The blanket mortgage is when two or more different parcels of property are offered. Okay, cool. And then that covers more than one wraparound mortgage. Okay, next question. If a lender is charging a borrower an interest rate of 5% and also charging the borrower 2 points, what is the lender's yield? A, 7%, B, 7.25%, C, 10%, or D, 5.25%. So definitely knowing the worth of, or the value of the points is going to be beneficial for the exam. All right, a quick answer. And that is correct. It's going to be D, 5.25%. Good work. And then down here with the question rationale is super helpful because it gives you the calculation or how you guys got 5.25% and how they got 5.25%. Okay. Which loan is not guaranteed or insured by government agency? A, conventional, B, VA, C, FHA, or D, amortized? Amortized?
It is not.
Oh no, how do you say that?
Guaranteed or insured by government agency,
But how do you say that word?
amortized.
Okay.
That's not kind of long, though.
Yeah. All right, good job, guys. It's correct. It is conventional. Okay. Well, both the mortgage deed and the mortgage note are signed by the borrower. The note is A, not really necessary. B, signed in duplicate with a copy each for the buyer and the bank. C, retained by the borrower as the reminder of its maturity date. Or D, not recorded. Okay, we got D and B. So D is correct, not recorded. So the mortgage deed is recorded to create the lien on the property. The mortgage note is the personal promissory note that is retained by the bank. It is not signed in duplicate as this would create two debts, which could both be called by the bank. So it's gonna be D, not recorded. Okay. A GI loan is the same as a blank loan. And A, FHA loan, B, conventional, C, VA, or D, co-insured. All right, good job. It's gonna be GI is the same as a VA loan. Perfect, good work. After the borrower makes the last payment on the loan secured by a deed of trust, which instrument will the trustee use to revest title to the borrower? A, reconveyance deed, B, limited warranty, C, trustee deed, or D, general warranty. Victoria say A. A is correct. It's going to be a reconveyance deed. Definitely knowing the difference between the various deeds. I know I keep saying, but letting you know what's going to be super helpful for the test, but knowing the difference between the various deeds and the tenant, in general, knowing vocabulary. And again, the question rationale gives a breakdown of each loan. So a general warranty deed conveys title from a grantor to a grantee, as does the limited warranty deed. A trustee deed is used by the trustee in the event of default. And then when the loan is paid in full in a title theory loan, entire theory state, the borrower finally gets title with a reconveyance deed. All right, a purchaser secured a loan using a deed of trust. Now that the borrower has defaulted on the loan, the trustee finds a buyer to sell the title to. Which instrument did the trustee use to convey title to the new owner? Is that A, deed of trust, B, trustee deed, C, reconveyance deed, or D, quitclaim deed? Look at that. I just read over the question rationale from the previous question and gives you this answer. All right, we got all. So the correct answer is B, a trustee deed. So the trustee deed, in default, the trustee is instructed by the lender to sell the property. When this happens, the trustee uses a trustee deed. Try to trick you, but basically whenever they are explaining a trustee and the loan was defaulted, it's going to be a trustee deed. Right, good job. Payment of debt in regular periodic installments of a principal and interest is referred to as a blank loan. Is referred to as a assignment of loan, a straight term loan, the amortized loan, or the assumption of loan. Right, we have see all around. Good job. All right, it's amortized loan. And again, definitely reading through the question rationale. Very helpful. A lump sum payment of principal is due at the end in which type of promissory note? A, wraparound, B, major, C, balloon, or D, fully amortized? All right, correct. It's going to be C, a balloon mortgage is one in which lump sum payment of principal is due at the end. All right. Which word or clause in a mortgage pledges real property as collateral for the debt? A, hypothecation, B, acceleration, C, acknowledgement, or D, accretion. A is correct. Good job. Always got that wrong. All right, that was a tough topic. Okay. Let me know what other topics you guys want to go over. Run by pretty quick. See what you- All right, transfer of title it is. All right, Bob's lawyer examines an abstract of title and gives him the opinion that the title is vested in William. Oh, we got Bob and William. This opinion is called A, certificate of no defense, B, chain of title, C, certificate of sale, or D, certificate of title. Okay, the majority said B. So it is gonna be D. So a certificate of title. A certificate of title, also known as an opinion letter, is given by a lawyer who has examined an abstract of title. The lawyer forms an opinion as to whom the title is vested. So definitely knowing that a certificate of title, another word for that is opinion letter. And that is written by the lawyer who has examined the abstract of title. Okay. Title is best described as A, insurance that guarantees one owns the property, B, a leasehold estate, C, ownership of land, or D, a document transferring a grantor's interest in real property. So what is the best definition of title? All right, we got C and D. Honestly, that's what I was gonna break it down to. Okay, we got two D. Okay, so the correct answer is gonna be C, ownership of land. Title means ownership. All right, good to know. So the best definition of title is ownership of land. An abstract of title is a chronological summary of the essential provisions of every recorded document pertaining to a particular parcel of land. B, sworn statement that title is good. C, contract whereby a title insurance company indemnifies the owner against loss due to defects and hidden risks on the title. Or D, written declaration by a person executing an instrument signed before an officer authorized to give a note. All right, good work. A is correct. The source of law that affect real estate transaction and activity are A, court decisions, B, local ordinance passed by towns, cities, and villages. C, state and federal legislation, or D, court decisions, local ordinances, and state and federal legislation. So we got D. All right, good job. That is correct. It's going to be D, court decisions, local ordinances, and state and federal legislations are all sources of law. Okay, an instrument in writing that transfers ownership of a tangible property is called A, bill of sale, B, blanket mortgage, C, mortgage, or D, listing.
Finding hourly workers.
Goodbye. Brian was on study session at one point. Oh, sorry, you guys are correct. It was A, bill of sale. Good work. Okay, good job. We flew through that one. Okay, next topic. So we just did transfer of title. You're struggling with any, you want to put some on? Down? All right, let's do land use control. All right. A new developer is giving some land in the subdivision to the city for the construction of new streets. The developer's act of giving land to a public agency is called A, deed restrictions, B, disintermediation, C, deed of trust, or D, dedication. Okay, we got D. Good job. D, dedication. Right. When a street gives new storm drains, what will the landowner pay in addition to the property taxes? A, special assessment, B, ad valorem, C, abatement, or D, lien. I actually just had a real life experience about this. All right, good job. It is a special assessment. Along with additional property taxes, the paying assessment. The local city council decides to reduce the assessment rate for a major corporation relocating to the area to build a manufacturing plant. Such a reduction is termed A, abatement, B, amortization, C, ad valorem, or D, assignment. Oh, good. That's the previous question. We now know what an assessment is. And then, good job. It is A, an abatement. An abatement usually refers to as a decrease in the assessed value of an ad valorem tax or an assessment rate used to compute the ad valorem tax. Okay. James worried that Peter would build a fence that would obstruct his view of the seashore. He expressed his concerns to Peter, who offered for $500 to agree that no fence would ever be constructed on Peter's land. They signed a written agreement and recorded it into the courthouse. They create A option, B easement running in James' favor, C restricted covenant, or D lien on Peter's property. All right, good job, guys. That is correct. It is going to be C, a restricted covenant. All right. The term abatement refers to A, reduction of assessment rate for tax computation, B, the obligation and promise to be personally liable for conditions in a contract, C, Latin term meaning runs with the land, D, a Latin term meaning according to valuation. All right. Good work. It is going to be A, reduction of assessment rate for tax. We're covering all the topics today. Thank you. Okay, next topic. Property ownership, land use control. We just did land use control. All right, valuation. I was actually just gonna click on. Cool. All right, the income approach is probably most appropriate for A apartment building, B residential property in a desirable area, C historical residential home, or D museum. Definitely knowing the difference between each approach for an appraiser is super helpful. An example for each. Or if we have A apartment building, A apartment building is correct. The income approach is best used for income producing properties, aka an apartment building. Nice. It would be unethical for an appraiser to A, ask for the payment in advance, B, base their payment on percentage of the appraised value, C, refuse to make commercial appraisal because they have only residential expertise, or D, appraise a property in which they have disclosed interest. C and B. All right, majority B. And that is correct. B, base their payment on percentage of the appraised value. Definitely cannot do that. All right. Staff appraisers might be used by a large corporation with many properties to manage, B, large mortgage company reviewing hundreds of appraisals a year, C, homeowner who wants an estimate of value, or D, both a large corporation with many properties to manage and a large mortgage company reviewing hundreds of appraisals a year. What else? B and D? All right, it's gonna be D. Both a large corporation with many properties to manage and a large mortgage company reviewing hundreds of appraisals a year. So these appraisers are normally salaried. Okay. The term appraisal refers to A, the obligation to be personally liable for conditions in a contract, B, an increase in value of property either due to positive improvements in the area or elimination of negative factors, C, a defensible opinion or estimate of value of real property as a certain date, or D, the value of real property fixed for purposes of computing taxes. So what is the best definition of an appraisal? Good job. That C is correct. Defensible opinion or estimate of value of real property as of a certain date. Good work. Income capitalization is most likely to be used when the subject property is A, an apartment complex, B, a school, C, single-family rental home, or D, a grocery store. So income capitalization is going to be used when A is correct. Income capitalization is used on large income producing properties. Formula is net divided by rate of return equals value. They try to trick you by saying that instead of income approach. Right. Which approach to appraisal is best for apartment building? A, comparison, B, income, C, estimate, or D, cost. I feel like we've got this several times now. All right, good job. It is going to be B, income. Income producing properties, aka apartment buildings, gleans the most accurate results from the income approach, either using the capitalization rate or calculating the gross rent multiplier. All right. Good job. Next question. When using the replacement cost approach to estimate the value of a home that is 3 years old, the appraiser should do which of the following? So now we're using replacement cost approach. A, adjust for inflation that has occurred since the sale of any comparable properties. B, estimate the cost on the basis of current prices of reproducing a replica home with the same or closely similar materials. C, determine replacement costs and then deduct for depreciation. Or D, capitalize the net income. There you go. Majority C. C is correct. Good job. It's going to be determine replacement costs and then deduct from depreciation. So a replacement cost estimate concerns the cost of replacing the subject property with one of equivalent utility, not a replica. The reproduction cost is an estimate of the cost of a building that is replicated. The period of time in which a building produces income attributable to the structure itself is its A, functional obsolete, B, effective age, C, economic life, or D, economic obsolescence. Right, good job. It is going to be the economic life. Definitely knowing the difference between all of these is very helpful. And the question rationale explains it for you. Okay. Next question. Which approach to an appraisal is best for existing single-family residents? So we're going to figure out which approach is best for single-family residents. Is that going to be A, cost approach, B, comparison approach, C, estimate approach, or D, income approach? B, comparison is correct. So CMA is going to be a comparative market analysis, and that's going to be the approach that appraisals kind of use as well. All right. A real estate licensee is performing a competitive market analysis. Look at this. They locate a comparable property that is slightly older than the subject property. The age of the comparable market makes it worth $2,000 less. The comparable has a small porch worth $1,000 that the subject property lacks. If the comparable sold for $269,500 recently, what is the estimated value of the subject property? Sorry if I confused anybody by reading that. So definitely taking your time to read the question. So what is the estimated value of the subject property? They're not asking about the comparable, they want to know the subject property. Are we asking? So it is going to be A. So it's going to be $270,500. And right down here, I'll show you how they got that. So at $269,500, then plus the $2,000, since it's in better condition than our comparable, it has an increase of $2,000. Then it doesn't have the small porch, so we're going to subtract the $1,000, and we get $270,500. Right. Ooh, so I think we'll have time for one more topic. Mhm. We're crushing all the topics. Did you take measures or anything? All right, let's do property disclosures. Home warranty programs, which typically cover such things as plumbing, electrical, heating, and air conditioning systems and appliances. This would be good for Brian. It just says home warranty. Yeah, sorry, no opinion. Are A, required if a buyer is securing a federally related mortgage loan. B, always provided and paid for by the seller when property is listed in multiple listing service. C, only recommended if a seller does not provide a property condition disclosure statement. Or D, optional programs purchased by buyers or sellers that include specified coverages, deductibles, limitations, and exclusions. All right, good job. It is D. It is optional. A buyer's agent is showing buyers a property for the first time. The buyer asks the agent if there is any dampness in the basement. The agent responds, to my knowledge, there is no dampness in the basement. The agent would be guilty of A, fraud, B, misrepresentation, C, nothing, as the agent is representing the best interest of the seller, C, or D, breach of the listing contract. B is correct. Good work. Definitely knowing the difference between fraud and misrepresentation. So fraud is an intentional misrepresentation, while misrepresentation can be negligent. So they didn't intentionally lie, but they didn't actually know or view the basement to make it that statement. A seller completes a property disclosure form and states that there are no conditions in the property in need of repair. However, the listing agent recognizes the early signs of termite infestation. The listing sales agent should A, disclose the condition to the buyer, as this is a latent defect. B, not tell the buyer and rely on the seller's statement in the property disclosure form. C, disclose the condition to the buyer as this is a patent defect. Or D, tell the seller to amend the property disclosure statement. So what should the listing agent do? So we got C and A. And C first. And C is correct. Disclose the condition to the buyer as this is a patent defect. All right. So although you may, they may not know how to look for termite infestation, but during a home inspection, they will definitely flag that. So disclose the condition to the buyer as it says the patent defect. When showing a listing, a sales agent is asked about the condition of the basement. Without having seen the basement, the agent states that to the best of his knowledge, the basement is free of dampness. In fact, the basement leaks steadily whenever it rains. The agent most likely has committed A, intentional misrepresentation, B, misrepresentation, C, no error, this is protecting the homeowner's interest, or D, fraud. Oh, this is not tricky. So intentional misrepresentation and fraud are the same thing. So if that helps everybody. And that is correct. It's going to be B, misrepresentation. So definitely knowing intentional misrepresentation is the same thing as fraud will be helpful because then that will just cross out some answers for you. And it's going to be misrepresentation. So if he knew that there was leaks after heavy rainfall and he still proceeded to say that he doesn't have any knowledge of it, that would be fraud. Okay. Which of the following is a latent defect that would need to be disclosed? A, decaying steps to a back porch. B, a crack in the basement wall that is covered by paneling. C, worn out carpeting. Or D, leaking faucet. All right, good job. It's already answering. B is correct. Yeah. A crack in the basement wall that is covered by paneling. Latent defect is a problem that would not be discovered by ordinary inspection. If a crack is hidden by paneling, it is not likely to be observed and therefore must be disclosed to prospective buyers. The other options are all plainly visible upon inspection and therefore are not latent defects. Definitely knowing the difference between latent and patent defects. All right. Well, thanks so much for joining, guys. Appreciate the participation.